Hi everyone, welcome to the first video and hopefully many videos I will be posting here about international income tax from a US perspective, but also I'm pretty sure I will go over time into more local subjects, topics, meaning purely US domestic topics. But let's start with the beginning. Disclaimer. As I will say in all my presentations here, this is not tax advice, this is not legal advice. Please do not rely on anything I say here. If you need advice, please reach out to a professional, CPA, lawyer, anyone professional and qualified. So that being said, the way I want to post about anything tax related here, income tax related mostly, I want to say, is going to be as follows. I will take a broad topic and then I will divide it into mini videos so that you don't have to listen to an entire hour, 2 hours of me blurbing and blah blahing about international income taxation. You can pinpoint the topic of your choice, the topic that's really interesting to you, to your specific situation, to your client's situation, and dive more into that. So today what we will be starting with are residency rules, because before the US can tax you, you have to be generally living here, being a resident, or it's more than before the US can tax you. It's in order to determine how the US can tax you, we need to understand whether you're a resident or a non-resident. Today, we're talking about only the federal tax laws, so no state or local taxation here. And also, we're only talking about residency in a strictly income tax sense, meaning in the US, there's a definition of residency when it comes between income tax and then estate and gift tax. In estate and gift tax terms, it's called domiciliation more than residency, really. But those two things are different. Think about them like two columns that never cross over, okay? Income tax, state and estate and gift tax. So we're in the income tax column and at the federal level today. Now, why do we really care about residency? As I was telling you earlier, well, it depends. Your residency status determines how the US can tax you. So here in my example, I have Inge from Germany, this beautiful red lady here. Inge did not seek advice from a US tax lawyer before she bought an apartment in New York, and now she's renting this apartment out and she has rental income from that apartment. So outright ownership of an apartment in New York or a house, whatever you want to call it, she has rental income. Now the US is going to say, hey, your house is in the US, the income is generated from something that you have in the US, therefore we have the right to tax. There are many exceptions to this, or some exceptions that I will touch upon in later slides, but in later presentations. But for now, let's just roll with this example as it is. So this rental income, now the US says, well, you're a non-resident, we have the right to tax. The tax rate for non-residents is just going to be a flat 30%. That's it. Now, no deductions, absent any planning, no deductions, no nothing. Just flat rate, 1,000 in income, boom, 30% goes to the US. Now, let's say that Inge starts traveling more and more to the US and she falls in love with who lives in the US. Now, well, I cannot go back. That was such a cute little slide. Anyways, Inge is in love and Inge starts coming more and more to the US to spend time with Annika. And out of a sudden, Inge, who has assets all over the world, especially in Europe, and those assets generate a lot of her income, well, Inge out of a sudden will be subject to tax in the US, not at 30% anymore, but she will first have the right to claim a bunch of deductions and expenses. And second, she will be taxed at gradual rates, the highest rate being 37%. And then you have a 2.8% net investment income tax that can come in addition to that for any passive type income. I'm not going to go into detail about this, but passive type is more interest, dividends, anything where you really don't have to work. It's like an investment portfolio, rental generally also. And then on wage income or self-employment income, there's also self-employment taxes. So those are the social charges. I'm not going to talk a bunch about them, but they're pretty substantial. So you do want to make sure that you understand that aspect as well. Now, the big question here is, when does one become a tax resident, an income tax resident at the federal level for US purposes? There are, of course, exceptions to all this that I will talk about in later slides, in later presentations, sorry. So first, who's an income tax resident? Well, US citizens. If you have citizenship, no matter where you live on the moon, you are liable to tax on your worldwide income in the US. And you also have a bunch of reporting obligations. You have to tell them where your bank accounts are, blah, 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 your assets, everything, all your companies, all your stock. They want to know. I'm simplifying, but that's the gist here. If you don't file those pure reporting obligations, even if you don't even owe any income taxes, there's a bunch of really, really salty penalties here in the US for that. And then the other category are what we call US residents, US resident aliens. And that category is really divided into two subcategories. You have the green card holders, that's pretty self-explanatory. And then you have the individuals that are residents because they fall under the substantial presence test. Now, green card, as I said, the green card, that's self-explanatory. You have a green card. The starting date, the ending date of your residency will be discussed in other presentations, but you have a green card, you're an income tax resident no matter where you live. That's the general rule. In terms of substantial presence test, that's where it gets a bit more complicated, because here, in order to fall under the substantial presence test, you have to meet two requirements. The first one is that in the testing year, the year for which we're testing your residency, you have to have spent at least 31 days in the US. And then, in addition to that, we're going to look at your over presence in the US over a 3-year period. And if you have spent 183 days or more during that 3-year period in the US, plus 31 days in the current year, you are an income tax resident for federal income tax purposes. Now, how do we count days in this 3-year look back period? Well, we are going to use different coefficients per year. So the current year, each day of presence will count as one full day of presence. In the previous year, each day of presence will count as 1/3 of a day of presence. And then in the second previous year, so -2, each day of presence will count as 1/6 of a day of presence. You compute all these numbers, all these days, and if you're equal or above 183 days plus 31 days in the current year, you're an income tax resident. Taxed worldwide, full disclosure obligation. Now, there's a lot of little details about these rules, but they're really the overall, like that's the logic of these rules. Now, what's important here is that one day of presence, it's a partial day of presence, even 1 hour in a day is counted as an entire day. So let's, for instance, take a really concrete example. You have, you fly into JFK, you land at 10 p.m. on April 4th, you spend 2 hours in immigration. Well, you are counting April 4th as an entire day of presence. It's the same thing when you depart the US. If you depart the US on April 30th, even if you depart the US at 1 a.m. in the morning, on April 30th is counted as an entire day of presence. And this is really important because that's when a lot of mistakes happen, and that's when you really want to make sure that you have your records straight. So how to make sure that your information is aligned with what the US has about you, or just remind yourself what exact days you were in the US. Well, you want to look at all your travel tickets. If you have stamps in your passport, look at those. Look at your Expedia account. I don't know where you buy your flight tickets, but look at those flight tickets. Look at, there is something called I-94 records on the US immigration website. Plug in, like just Google I-94 records, USCIS. Make sure you're on a website that ends in .gov. Click on I-94 records and then enter, I think they want your passport number and your date of birth or something like this. I forgot what they want. And they will give you, I think, up to 5 years of records or 3 years, I forgot. But they will give you the dates that they have in their system in terms of entry and leaving the US. This doesn't work for citizens, but it works for immigrants. And I'm not sure it doesn't work for green card holders. It's only if you're here on a visa other than a green card. All right, so here I have an example. We have this wonderful French family, the Dupont family, for a lack of better example. We have the mother, the father, and the daughter. They travel back and forth between the US and France. And then the mother, she's really in the real estate business, and she's also having like real estate hotels, and she wants to expand to the US market. So her husband is a politician in France, so he's going to be spending most of his time in France, but she's starting to travel a lot, and her daughter also is attending Berkeley. So now she has contacted us, she has provided us with all her travel information. She's like, don't worry about past years, look at the current year, whatever she tells me. She gives me instructions, and she just like sends us sheer numbers that she has counted. So we don't have the background of these numbers, okay? And let's assume we're in 2020 here. 2022, that's our test year, okay? So we're going to look at her days of presence in 2022. We multiply those days of presence by 1. For 2021, we multiply her days of presence by 1/3, and for 2022, we do the same, but we multiply by 1/6. That gives us a result. We don't really round up to a higher number. It doesn't matter. That those are just little details for now that you shouldn't think about too much. But here you can see that now, she's below, based on the numbers she sent us, she's below 183 days over this 3-year period. And although she has spent way above 31 days in the US in 2022, because she is below 183 days over those 3 years, she doesn't meet the 2 prongs of the residency definition. Therefore, she is not a resident in 2022. Now we're like, well, ma'am, you have a lot of real estate, a lot of income, and potentially a lot of reporting obligations. So we in the US, if you were a income tax resident, so we do want to make sure that she computes the days of presence the way she should. Sorry, I hope it didn't like interrupt too much. I had to go back and stop the recording, and now I'm back. But now she sends us, we ask her for the background of her computation and what she sends us. So I'm sorry because my head is on the smack top of the computation, and I don't know how to change the location of my head. But she sends us these numbers. Wait up, what numbers? Why is this not working? Well, that is annoying. Okay. All right, I'm back. So she sends us this computation. Sorry again, my head is in the really wrong place. But you can see that based on her computation, we are not at 175. We are, well, you cannot really see it, but we are well above 100, well, not well above, but we are above 183 days. And as a result, Madame Dupont, without even realizing, has become an income tax resident of the US, and she thought she had no income in the US because she had not really invested yet in the US. Out of a sudden, her entire worldwide income is subject to US income tax. She didn't know it. She might have triggered some income tax recognition events in the US, thinking she was not a resident because she was restructuring on the French side. These restructurings had a direct impact on her income tax liability in the US, so it's going to be huge. There's no cash event in France that matches this huge income tax liability. And also, she had a bunch of reporting obligations that she violated. So, in the next presentations, we will talk about exceptions. We will talk about treaty benefits. We will talk about exceptions under current law to see how we can get Madame Dupont out of this little conundrum here, if we can get her out of it, and what other exceptions exist. All right, I hope you enjoyed this first presentation, and see you very soon, I hope. Bye.